Here is what this session covers. Part A. What is property custodianship? Part B. Responsibility, accountability, and liability. Part C. Bonding of accountable officers. Part D. Transfer of accountability and disposition on death, incapacity, absence. Here is what this session covers. Part A. What is property custodianship? Part B. Responsibility, accountability, and liability. Part C. Bonding of accountable officers. Part D. Transfer of accountability and disposition on death, incapacity, absence, or supersession. Part E. Insurance of government property. Part F. Relief from accountability. Part G. Storage, warehousing, and stacking. Part H. Inventory taking. Part 1. Property records, including semi-expendable property. Part J. Repair and maintenance of property. Part K. Legal and regulatory basis, consolidated. Part L. 20 common misconceptions. Part M. 20 pitfalls and corrections. Part N. 20 audit deficiencies. Part O. 15 challenging questions. This session covers a lot of ground. The theory of responsibility, accountability, and liability. What happens to property when an accountable officer dies or disappears? The full relief from accountability process, storage and inventory taking, and repair and maintenance rules, each with its own specific numbers to remember. Next slide. Part A. What is property custodianship? The guardianship function that runs from receipt of property through its eventual issuance, repair, and safekeeping. This opening part defines property custodianship itself, broader than most people assume, covering receipt, safekeeping, issuance, and repair, not just holding an item in storage. Next slide. Defining property custodianship. At its core, property custodianship is the ongoing guardianship an accountable person exercises over government property, a function that spans receiving supplies and equipment, keeping them safe, releasing them for use, and seeing to their repair. It also includes the accountability, responsibility, and liability of accountable or responsible officers arising from loss, misuse, damage, or deterioration of government property due to fault or negligence in safekeeping. Custodianship is not confined to physically holding property. It is a continuous function that begins with acquisition and continues until the property is disposed of. Now, in a bit more detail, notice how much broader this definition is than the everyday sense of custodianship. It is not just physical possession. The law bundles in receipt, safekeeping, issuance, and repair and maintenance, plus the accountability and liability that attach to all of it. Next slide. Part B. Responsibility, accountability, and liability. 3 related but distinct concepts that determine who answers for government property, and how. This part is the theoretical core of the session, the precise difference between responsibility, accountability, and liability, and how each attaches to specific people under the law. Next slide. 3 distinct concepts. Responsibility is the acceptance of assigned authority and the obligation to prudently exercise an assigned or imputed role, the obligation to perform a task or comply with a rule. Accountability refers to the answerability of every public officer whose duties permit or require the possession, custody, or safekeeping of government funds or property. Liability is the obligation that arises as a consequence of an illegal or improper act, or the non-performance of what one is mandated to do. It may be administrative, civil, or criminal, and is comprehensive, embracing all obligations a person is bound to discharge in law or in equity. Now, in a bit more detail. These 3 terms get confused constantly in casual conversation, but they answer 3 different questions. Responsibility asks what you are obligated to do. Accountability asks who answers for the property, and liability asks what happens when something goes wrong. Next slide. Here is the text of the provision. Read exactly as written. The head of any agency of the government is immediately and primarily responsible for all government funds and property pertaining to his agency. Persons entrusted with the possession or custody of the funds or property under the agency head shall be immediately responsible to the head of the agency, without prejudice to the liability of either party to the government. In a bit more detail, notice the 2-layer structure this creates. The head of agency is primarily responsible for everything, and the accountable officer who actually holds the property is responsible to that head of agency, but critically, without prejudice to either party's own liability. Neither layer cancels out the other. Next slide. Who is accountable, and the measure of liability. An accountable officer is any officer or employee of the government who, by reason of office or duties, is required or permitted to have custody of public funds or property. Every officer accountable for government property is liable for its money value in case of improper or unauthorized use or misapplication, whether by himself or by any person for whose acts he may be responsible, and is likewise liable for losses, damages, or deterioration occasioned by negligence in the keeping or use of the property, whether or not it was in his actual custody at the time. No accountable officer shall be relieved from liability by reason of having acted under the direction of a superior officer, unless he notified the superior in writing of the illegality of the payment, application, or disposition before the act took place, in which case, the directing superior becomes primarily liable and the accountable officer only secondarily liable. Now, in a bit more detail, the measure of liability rule is worth noting specifically. An accountable officer is liable for loss due to negligence, whether or not it be at the time in his actual custody. Liability does not switch off just because the item happened to be elsewhere when it was lost. Next slide. Warning. Silence does not protect an accountable officer from a superior's illegal directive. An accountable officer who simply complies with a superior's illegal directive, without first giving written notice of its illegality, remains liable. The written objection, made before the act, is what shifts primary liability to the directing superior. Verbal objection, or objection raised only after the fact, does not have this effect. In a bit more detail, the critical word in this warning is written. A verbal objection, however sincere, does not shift liability away from the officer who ultimately carried out the illegal directive. Only a written objection made before complying does that. Next slide. Part C. Bonding of accountable officers. The fidelity requirement that attaches to anyone entrusted with government property. This part covers bonding, the fidelity requirement that attaches to anyone entrusted with government property, and exactly when that bond actually takes legal effect. Next slide. The bonding requirement. Every officer, agent, and employee of the government, its agencies and instrumentalities, GOCCs, and SUCs, regardless of appointment status, whose duties require the possession, custody, or control of public funds or property for which they are accountable, is deemed a bondable officer and must be bonded, with fidelity insured. A bond is an undertaking that is sufficiently secured. A bondable officer is one whose duties permit or require custody of property for which he or she is accountable. The bond becomes effective upon payment of the premium, not merely upon designation to a position that requires bonding. Now, in a bit more detail. Notice this applies regardless of appointment status, permanent, temporary, casual, or contractual, it does not matter. What triggers the bonding requirement is the nature of the duties, not the nature of the appointment. Next slide. Part D. Transfer of accountability and disposition on death, incapacity, absence, or supersession. What happens to property accountability when the officer holding it changes, disappears, or can no longer serve? This part covers what happens to property accountability when the person holding it changes, through ordinary transfer, or through death, incapacity, or disappearance. Next slide. When property accountability transfers. Property accountability transfers when property is no longer serviceable or no longer needed and is transferred from one agency to another, without cost or at appraised value. It also transfers when property moves from one accountable officer to another, or from an outgoing officer to a successor, in which case the outgoing officer must secure clearance for property accountability before being released. The prescribed form for these transfers is the Property Transfer Report. Now, in a bit more detail, the word clearance is doing a lot of work in this slide. An outgoing officer is not simply free to leave once a successor arrives. Clearance for property accountability has to be secured first, as a formal step, not an assumption. Next slide. Disposition of property held by a deceased, incapacitated, absconding, or superseded officer. When an officer accountable for government funds or property absconds with him, dies, or becomes incapacitated in the performance of duties, the agency head designates a custodian to take charge of the funds or property until a successor is appointed and qualified. The agency head may appoint a committee to count the cash and inventory the property for which the officer was accountable, and to determine responsibility for any shortage. One certified copy of the inventory and committee report is filed with Commission on Audit, though the findings are not conclusive until approved by the Commission or its duly authorized representative. If the officer was accountable for provincial or city funds or property, the custodian and committee are designated by the Secretary of Finance. If for municipal or barangay funds or property, by the provincial treasurer. If the absconding, deceased, incapacitated, or superseded officer was responsible to another accountable officer, that officer may designate the committee, or take other lawful measures to protect their own interest. Now, in a bit more detail. Follow the chain of authority carefully here, because it changes depending on the level of government involved. The agency head generally designates the custodian and committee, but for provincial or city funds it is the Secretary of Finance, and for municipal or barangay funds it is the provincial treasurer. Next slide. Part E, Insurance of Government Property. The agency head's continuing obligation to insure property under the GSI's Property Insurance Fund. This part covers a duty that is easy to forget precisely because it only comes due once a year, the agency head's obligation to insure government property through GSIs. Next slide. The agency head's insurance responsibility. The agency head is responsible for insuring government property under the Property Insurance Fund administered by the Government Service Insurance System, GSIs. The agency head must submit a verified inventory to the GSIs not later than October 31st of the ensuing year. This is a recurring, annual obligation, not a one-time registration. Now, in a bit more detail, the specific date to remember is October 31st, not the end of the calendar year, not a rolling deadline, but that specific date, every year, without exception. Next slide. Part F, Relief from Accountability. The process by which an accountable officer may be excused from liability for a loss, and the documents Commission on Audit requires to grant it. This part covers the full relief from accountability process in detail. Who decides based on the amount involved, who may file, and the specific documents Commission on Audit requires. Next slide. Here is the text of the provision, read exactly as written. Whenever warranted by the evidence, credit for loss shall be allowed. Any public officer who fails to comply with the requirement shall not be relieved of liability or allowed credit for any loss in the settlement of his account. In a bit more detail, the operative phrase is, whenever warranted by the evidence. Relief is not a formality granted automatically once a loss is reported. It depends entirely on the accountable officer actually producing the evidence the process requires. Next slide. Jurisdiction over requests for relief. Commission on Audit's Commission proper has original jurisdiction over requests for relief from accountability for losses due to acts of man, theft, robbery, arson, and similar causes, in amounts exceeding 5 million pesos, 5,000 pesos. At the level of the audited entity, the auditor decides on requests where the amount does not exceed 100,000 pesos, and the cluster or regional director decides where the amount is more than 100,000 pesos but does not exceed 500,000 pesos. The complete threshold table, including which reviewing authority handles amounts between 500,000 pesos and 5 million pesos, should be verified directly against the full text of Commission on Audit Resolution number 2021-008, since only the lower and upper bands are illustrated here. Now, in a bit more detail, pay close attention to the two bounds that are clearly established, the auditor for amounts up to 100,000 pesos, and the Commission proper for amounts exceeding 5 million. Note that the source material for this session did not fully specify who handles amounts in between the middle bracket and the Commission proper's threshold, so if you need the complete table, verify it against the full text of the relevant Commission on Audit resolution rather than relying on this summary alone. Next slide. Who may file, and where? Persons accountable for government funds and property that were lost or damaged without negligence on their part in the custody thereof, or their representative, may file the request. The request is filed with the audit team assigned at the government agency where the accountable officer is assigned. Two prerequisites must both be satisfied: notice of the loss to the head of agency and the assigned auditor, and the request for relief itself, filed within 30 days or such longer period as Commission on Audit may allow. Now, in a bit more detail. Notice the two separate deadlines packed into one rule. Notice of loss must be given, and the formal request must be filed within 30 days, or a Commission on Audit approved longer period. Missing either one can jeopardize the whole request. Next slide. Core documentary requirements. A basic notice of loss showing the exact date of filing and receipt at the office of the auditor concerned. An affidavit of the accountable officer stating the facts and circumstances of the loss, plus affidavits of 2 disinterested persons cognizant of those facts. A final investigation report from the office or department head or the proper government investigating agency, e.g., PNP, BFP, NBI. A list and description of the lost properties, including book value, date of acquisition, property number, account classification, and condition, attested by the concerned officials. The latest inventory and inspection report preceding the loss, and an inspection report on the extent of the damage or loss. A memorandum receipt covering the lost properties, if any, and a categorical determination by the concerned director or auditor on the absence of fault or negligence on the part of the accountable officer. Now, in a bit more detail. Do not try to memorize this list item by item in isolation. Instead, notice the underlying logic. Prove the loss happened, prove when it was reported, prove there was no negligence, and prove exactly what was lost and its value. Every document on this list serves one of those 4 purposes. Next slide. Tip: match the supporting documents to the actual cause of loss. Beyond the core documents required in every case, Commission on Audit Memorandum number 92 to 751 calls for cause-specific evidence, a veterinarian's certificate and autopsy report for a government animal, authenticated site photographs and a fire insurance policy for loss by fire or theft, and a proper official certification for losses due to calamity. Build the request around the actual cause of loss, not a generic checklist. In a bit more detail, think of the core documentary requirements as the baseline, and the cause-specific documents as what actually makes a request succeed or fail. A veterinarian's certificate is meaningless for a theft case, and a fire insurance policy is meaningless for a lost government animal. Match the evidence to the actual cause. Next slide. Part G. Storage, warehousing, and stacking. Planning the physical space where property is kept, and how it is arranged once there. This part covers the physical side of custodianship, how storage space is planned, and the 3 recognized types of stacking. Next slide. Storage and storage planning. Storage, in this context, is not simply stacking items in a room, it is the deliberate, economical management of how materials are received, held, and released so they stay safe and can be retrieved quickly when needed. The responsibility for planning that storage space belongs to the property or supply management chief, who works out the layout with the agency's technical staff and brings the resulting plan to the head of agency for approval before construction or setup begins. Now, in a bit more detail. Notice who actually has this responsibility. Not the head of agency directly, but the property or supply management chief, working with technical personnel, with the head of agency's role limited to final approval of the plan. Next slide. Types of stacking. Bulk storage handles the largest volumes, big block stacks reserved for large quantities of a single item. Medium lot storage sits in between. Roughly a 3-pallet stack footprint, built up to the maximum practical storage height. Small lot storage covers everything smaller still, from a single container up to a lot of 2 or more pallets, provided it falls short of what a full pallet stack would require. As a general rule, stocks should start at the wall and work forward toward the aisle, so that stacks built in a large center section start from an imaginary back line and are built forward to the aisle. Now, in a bit more detail. The distinguishing factor across these 3 types is simply volume: bulk storage for the largest quantities, medium lot for a moderate footprint of about 3 pallet stacks, and small lot for anything smaller still. Size, not item type, is what determines the classification. Next slide. Part H. Inventory taking. The physical stock take that verifies custodianship is doing its job. This part covers inventory taking, the physical stock take that verifies whether custodianship is actually working, and the committee structure required to conduct it properly. Next slide. Planning and conducting the inventory take. Inventory taking is an indispensable procedure for checking the integrity of property custodianship, the physical stock taking of equipment and supplies that serves as the basis for preparing accounting reports. An inventory committee is created, composed of 2 or more employees including the supply or property officer or custodian, with membership scaled to the extent of the property accountability in the particular agency. After the physical inventory take, the inventory committee reconciles the count results with the property and accounting records. The count is not complete until this reconciliation happens. Now, in a bit more detail. The sequence that matters here is, count first, then reconcile. A physical count that is never reconciled against the books has not actually accomplished its purpose as a detective control. Next slide. Part 1. Property records, including semi-expendable property. The forms the property or supply section keeps, and the current classification rules for semi-expendable items. This part covers the specific forms the property or supply officer must maintain, and the current, updated threshold for what counts as semi-expendable property. Next slide. Forms maintained by the property or supply officer. Inventory custodian slip, purchase request, and requisition and issue slip, the core issuance side documents. Stock card, and property acknowledgement receipt, records of what is held and by whom. Report on the physical count of inventories, RCPI, report on the physical count of property, plant and equipment, RPCPPE, an inventory and inspection report of unserviceable property, IIRUP. These are only some of the numerous forms and registries kept by the property or supply section. The complete set is found in GAM for NGAs, Volume 2, and, for semi-expendable property specifically, in Commission on Audit Circular No. 2022-004 and its annexes. Now, in a bit more detail. This is a reference list more than a set of concepts to memorize in this format. But do notice that it spans far more than just the property card, including reports specifically about physical counts and unserviceable property. Next slide. The current semi-expendable property threshold. The capitalization threshold for tangible items to be recognized as property, plant and equipment was raised from 15,000 pesos to 50,000 pesos. Tangible items that meet the definition and recognition criteria of PPE, but cost below 50,000 pesos, are accounted for in the books as semi-expendable property. Semi-expendable property is further classified into low-valued items, each costing 5,000 pesos or less, and high-valued items, each costing more than 5,000 pesos but less than 50,000 pesos, a distinction that affects which annexed forms and reports apply. Now, in a bit more detail, the number to remember is 50,000 pesos, that is the current capitalization threshold, up from the old 15,000 peso figure. Below that threshold, and the item is semi-expendable, further split into low-valued and high-valued categories at the 5,000 peso mark. Next slide. Part J. Repair and maintenance of property. When wear and tear is normal, when repair is warranted, and when it no longer makes economic sense. This part covers repair and maintenance, the difference between ordinary wear and major repair, and two specific cost thresholds that determine when a repair no longer makes economic sense. Next slide. Fair wear and tear versus major or extraordinary repair. Fair wear and tear is the condition of equipment that has become worn out or otherwise unserviceable through ordinary use, without apparent fault. Major or extraordinary repair covers alteration, addition, installation, general reconditioning, overhauling, and similar work that materially increases the value or extends the useful life of equipment or motor vehicles. Now, in a bit more detail, the distinguishing question to ask is whether fault is involved and whether value is being added. Fair wear and tear happens without fault through ordinary use. Major repair actively increases value or extends useful life through deliberate work. Next slide. Cost limits on repair. When the cost of repair exceeds 50% of the property's fair market value, the property is considered no longer economically repairable. Fair market value, for this purpose, is the amount for which an asset could be exchanged or a liability settled between knowledgeable, willing parties in an arm's-length transaction. Payment for the repair of government equipment shall not exceed 30% of the current market price of the same or similar equipment. A repair exceeding that limit is treated as an in effect unauthorized use or expenditure of government funds and property. Now, in a bit more detail, two separate numbers matter here, and they are easy to confuse with each other. 50% of fair market value is the threshold beyond which repair is no longer considered economical, while 30% of current market price is the cap on what may actually be paid for a repair. Next slide. Part K. Legal and regulatory basis. The issuances underlying every provision cited in this session. This part consolidates every legal citation used throughout the session into one place, for quick reference. Next slide. Consolidated legal and regulatory basis. Presidential Decree No. 1445, Government Auditing Code of the Philippines, Sections 73, 78, 101, 102, 105, and 106, Accountability, Liability, Relief from Accountability, and Disposition on Death or Incapacity or Absence or Supersession. Commission on Audit Circular No. 2009-006, September 15, 2009, the rules and regulations on the settlement of accounts, including the definitions of accountability applied in this session. Commission on Audit Memorandum No. 92-751, February 24, 1992, documentary requirements for requests for relief from accountability. Section 1, Rule 8, 2009 Revised Rules of Procedure of the Commission on Audit, as amended by Commission on Audit Resolution No. 2021-008, May 12, 2021, Jurisdiction over Requests for Relief from Accountability. Treasury Circular No. 02-2019, April 25, 2019, Bonding of Accountable Officers. Commission on Audit Circular No. 2022-004, May 31, 2022, and its annexes, Capitalization Threshold and Semi-Expendable Property Classification, Forms, and Records. GAM for National Government Agencies, Volume 2, Prescribed Property Forms, Registries, and Reports. Now, in a bit more detail, take a moment to connect this back to the general principle introduced earlier in this part, since that is the thread tying every slide in this section together. Next slide. Part L, 20 Common Misconceptions. Each entry pairs a commonly held but incorrect belief with the accurate rule and its legal basis. This part tests your understanding by presenting 20 commonly held but incorrect beliefs about custodianship, each paired with the accurate rule. Next slide. 20 Common Misconceptions. Number 1. Myth. Property custodianship means simply holding physical possession of an item. Fact. Custodianship covers receipt, safekeeping, issuance, and repair or maintenance, plus the accountability and liability that attach throughout, not just physical possession. Number 2. Myth. Responsibility, accountability, and liability are interchangeable terms. Fact. They are distinct. Responsibility is the obligation to perform a task, accountability is answerability for custody, and liability is the consequence of an illegal or improper act. Next slide. 20 Common Misconceptions. Number 3. Myth. Only the accountable officer in physical custody bears responsibility for agency property. Fact. The head of agency is immediately and primarily responsible for all agency funds and property. Persons entrusted with custody are responsible to the agency head, without prejudice to either party's liability. Number 4. Myth. An accountable officer who follows a superior's illegal directive is automatically excused from liability. Fact. The officer remains liable unless written notice of the directive's illegality was given to the superior before the act. Only then does liability shift to the superior. Next slide. 20 Common Misconceptions. Number 5. Myth. Only permanent employees need to be bonded as accountable officers. Fact. Bonding applies regardless of appointment status, to anyone whose duties require possession, custody, or control of public funds or property. Number 6. Myth. A bond takes effect as soon as an officer is designated to a position requiring one. Fact. The bond becomes effective only upon payment of the premium. Next slide. 20 Common Misconceptions. Number 7. Myth. An outgoing accountable officer may simply leave the position without formal clearance. Fact. The outgoing officer must secure clearance for property accountability as part of the transfer process. Number 8. Myth. If an accountable officer dies or disappears, their property accountability simply lapses. Fact. The agency head designates a custodian to take charge of the funds or property until a successor is appointed and qualified. Next slide. 20 Common Misconceptions. Number 9. Myth. Insuring government property with GSIs is a one-time registration, done once and never repeated. Fact. The agency head must submit a verified inventory to GSIs annually, not later than October 31st of the ensuing year. Number 10. Myth. Relief from accountability is automatically granted once a loss is reported. Fact. Relief is granted only when warranted by the evidence. Failure to comply with the documentary requirements bars relief. Next slide. 20 Common Misconceptions. Number 11. Myth. Any Commission on Audit auditor may decide a request for relief from accountability, regardless of amount. Fact: jurisdiction depends on the amount involved, auditor, cluster or regional director, or the Commission proper, depending on the threshold reached. Number 12. Myth: a generic notice of loss is sufficient documentation for any relief request, regardless of cause. Fact: cause-specific evidence is also required. For example, a veterinarian's certificate for a lost government animal, or a fire insurance policy for a fire loss. Next slide. 20 common misconceptions. Number 13. Myth: warehouse layout and stacking method are matters of convenience, with no prescribed approach. Fact: recognized stacking types, bulk, medium lot, small lot, and the start at the wall, build toward the aisle approach are the standard practice. Number 14. Myth: inventory taking is solely the property officer's individual task. Fact: an inventory committee of 2 or more employees, including the property or supply officer or custodian, is created to conduct it. Next slide. 20 common misconceptions. Number 15. Myth: once the physical count is finished, inventory taking is complete. Fact: the count is not complete until the inventory committee reconciles it against the property and accounting records. Number 16. Myth: the PPE capitalization threshold is still 15,000 pesos. Fact: the threshold was raised to 50,000 pesos by Commission on Audit Circular Number 2022-004, items below that are semi-expendable property. Next slide. 20 common misconceptions. Number 17. Myth: all semi-expendable property is treated the same way regardless of unit cost. Fact: semi-expendable property is further classified into low-valued, 5,000 pesos or less, and high-valued, more than 5,000 pesos but less than 50,000 pesos, items. Number 18. Myth: any repair cost is acceptable as long as the equipment can still function afterward. Fact: repair exceeding 50% of fair market value renders the item no longer economically repairable, and payment for repair may not exceed 30% of current market price for the same or similar equipment. Next slide. 20 common misconceptions. Number 19. Myth: fair wear and tear and negligence are the same thing for liability purposes. Fact: fair wear and tear is deterioration through ordinary use without apparent fault, which is distinct from loss or damage caused by negligence. Number 20. Myth: major or extraordinary repair is defined only by its cost, not its nature. Fact: it is defined by the nature of the work, alteration, addition, installation, general reconditioning, or overhauling that materially increases value or extends useful life. Next slide. Part M. 20 pitfalls and corrections. Recurring operational weaknesses in property custodianship, storage, inventory taking, and repair. This part shifts from beliefs to behavior. 20 recurring operational mistakes actually seen in custodianship, storage, and repair, and the specific correction for each one. Next slide. 20 pitfalls and corrections. Number 1. Pitfall: custodianship records stop at the point of receipt, with no tracking through issuance and repair. Correction: maintain records that follow the property continuously, from receipt, through issuance, repair, and eventual disposal. Number 2. Pitfall: no formal designation or bonding paperwork exists for staff who actually handle custody of property. Correction: confirm bonding status and documentation for every staff member whose duties require custody of accountable property. Next slide. 20 pitfalls and corrections. Number 3. Pitfall: an accountable officer objects verbally to a superior's questionable directive, with nothing in writing. Correction: put any objection to a superior's directive in writing before complying, to preserve the possibility of relief from liability. Number 4. Pitfall: an outgoing accountable officer transfers duties without securing a clearance for property accountability. Correction: require a completed clearance process before releasing an outgoing officer from further accountability. Next slide. 20 pitfalls and corrections. Number 5. Pitfall: GSI's property insurance submissions are made irregularly, sometimes skipping a year entirely. Correction: calendar the annual GSI's verified inventory submission and treat the October 31st deadline as a standing requirement. Number 6. Pitfall: a relief from accountability request is filed with only the notice of loss and a brief explanation. Correction. Assemble the complete document set required by Commission on Audit Memorandum number 92 to 751 before filing, matched to the actual cause of loss. Next slide. 20 pitfalls and corrections. Number 7. Pitfall. A relief request is filed with the wrong reviewing authority for the amount involved. Correction. Confirm the applicable threshold, auditor, cluster or regional director, or commission proper, before filing. Number 8. Pitfall. The notice of loss is filed well after the 30-day period, with no request for extension. Correction. File the notice of loss and the relief request within 30 days, or formally request the longer period Commission on Audit may allow. Next slide. 20 pitfalls and corrections. Number 9. Pitfall. Warehouse stock is stacked wherever space allows, with no defined storage plan. Correction. Have the property or supply management chief prepare a storage plan, coordinated with technical personnel and approved by the head of agency. Number 10. Pitfall. Inventory taking is conducted by the custodian alone, without an inventory committee. Correction. Constitute a proper inventory committee of 2 or more employees before conducting the count. Next slide. 20 pitfalls and corrections. Number 11. Pitfall. Physical count results are filed without reconciling them against property and accounting records. Correction. Complete the reconciliation step as part of the inventory taking process, not as an optional follow-up. Number 12. Pitfall. Semi-expendable items are still recorded using the old 15,000 pesos threshold. Correction. Apply the current 50,000 pesos capitalization threshold from Commission on Audit Circular number 2022-004 to all current recognition decisions. Next slide. 20 pitfalls and corrections. Number 13. Pitfall. Low-valued and high-valued semi-expendable items are tracked identically, with no distinction noted. Correction. Note the low-valued or high-valued classification in the property records, since it affects which forms and reports apply. Number 14. Pitfall. A repair proceeds without first estimating whether cost will exceed 50% of fair market value. Correction. Estimate repair cost against fair market value before authorizing the repair, to catch uneconomical repairs early. Next slide. 20 pitfalls and corrections. Number 15. Pitfall. Repair payments are approved without checking them against the 30% of current market price cap. Correction. Verify repair payment amounts against the 30% cap before approval. Number 16. Pitfall. Loss due to ordinary fair wear and tear is investigated as though negligence was suspected by default. Correction. Distinguish fair wear and tear from negligence-based loss before deciding whether a relief from accountability process is even needed. Next slide. 20 pitfalls and corrections. Number 17. Pitfall. Property or supply staff are unfamiliar with which forms are theirs to maintain versus accountings. Correction. Clarify, in writing, which of the property forms, stock card, property card, PAR, ICs, RCPI, RPCPPE, IRUP, the property or supply section itself maintains. Number 18. Pitfall. The committee designated on the death or incapacity or absence of an accountable officer is chosen informally, with no documented designation. Correction. Formally designate the custodian and committee per PD number 1445, section 78, with documentation on file. Next slide. 20 pitfalls and corrections. Number 19. Pitfall. Property transfer reports are used interchangeably for PPE and inventory item transfers without distinction. Correction. Use the property transfer report for PPE and the inventory transfer report for inventory items, as the specific transaction requires. Number 20. Pitfall. A committee's inventory findings on a superseded officer's accountability are treated as final immediately. Correction. Treat the committee's findings as provisional until approved by the Commission or its duly authorized representative. Next slide. Part N. 20 audit deficiencies. Findings typically raised on custodianship, storage, inventory taking, and repair, matched to the provision each violates. This part presents 20 audit findings in the exact style you will see in a real audit observation memorandum, each tied to the provision it violates. Next slide. 20 audit deficiencies. Number 1. Deficiency. Accountable officers handling agency property found not bonded, or with lapsed bonds. Number 2. Deficiency. No written objection on file for an accountable officer who complied with a questionable superior directive. Next slide. 20 audit deficiencies. Number 3. Deficiency. Outgoing accountable officer released without a completed property accountability clearance. Number 4. Deficiency. GSI's verified inventory not submitted by the October 31st annual deadline. Next slide. 20 audit deficiencies. Number 5. Deficiency. Relief from accountability request granted or processed without the required commission on audit memorandum number 92 to 751 documents. Number 6. Deficiency. Relief from accountability request decided by an authority without jurisdiction over the amount involved. Next slide. 20 audit deficiencies. Number 7. Deficiency. Notice of loss or relief request filed beyond the 30-day period with no commission on audit-approved extension. Number 8. Deficiency. No documented storage or warehouse plan despite significant volumes of stock on hand. Next slide. 20 audit deficiencies. Number 9. Deficiency. Physical inventory conducted without a properly constituted inventory committee. Number 10. Deficiency. Inventory count results left unreconciled against property and accounting records. Next slide. 20 audit deficiencies. Number 11. Deficiency. Semi-expendable property recorded using the superseded 15,000 pesos threshold instead of the current 50,000 pesos. Number 12. Deficiency. Low-valued and high-valued semi-expendable property not distinguished in agency records. Next slide. 20 audit deficiencies. Number 13. Deficiency. Repair authorized despite estimated cost exceeding 50% of the item's fair market value. Number 14. Deficiency. Repair payment approved in excess of 30% of the current market price of similar equipment. Next slide. 20 audit deficiencies. Number 15. Deficiency. No custodian or committee formally designated upon the death, incapacity, or absence of an accountable officer. Number 16. Deficiency. Committee findings on a superseded officer's accountability treated as final without commission approval. Next slide. 20 audit deficiencies. Number 17. Deficiency. Property transfer report used for an inventory item transfer that should have used the inventory transfer report, or vice versa. Number 18. Deficiency. Core custodianship forms, stock card, property card, PAR, ICs, not maintained or incomplete. Next slide. 20 audit deficiencies. Number 19. Deficiency. Agency head found not primarily and immediately responsible for agency property in practice, despite the statutory default. Number 20. Deficiency. Loss attributed to negligence in safekeeping, with no bonding or accountability documentation to establish the officer's status. Next slide. Part O. 15 challenging questions. A mixed format comprehension check, true or false, error spotting, multiple choice, and short scenarios, for self-testing at an advanced level. This final part is a genuine comprehension check. 15 challenging questions in a mix of formats, designed to test whether you actually understood the material. Next slide. 15 challenging questions. Number 1. Q. True or false. Responsibility, accountability, and liability are three names for the same legal concept. False. Responsibility is the obligation to perform a task. Accountability is answerability for custody, and liability is the consequence of an illegal or improper act. Each is distinct. Number 2. Q. Spot the error. Under Section 102 of PD number 1445, only the accountable officer in physical custody is responsible for agency property. Correct the statement. The head of agency is immediately and primarily responsible for all agency property. The accountable officer's responsibility exists without prejudice to the agency head's own. Next slide. 15 challenging questions. Number 3. Q. Multiple choice. An accountable officer avoids liability for complying with a superior's illegal directive by complying quickly to minimize damage. B. Giving written notice of the directive's illegality before complying. C. Reporting it after the fact. D. Nothing. Liability is unavoidable. A. B. Written notice before the act shifts primary liability to the directing superior. The officer becomes only secondarily liable. Next slide. 15 challenging questions. Number 4. Q. True or false? A government bond becomes effective the moment an officer is designated to a position requiring one. False. The bond becomes effective only upon payment of the premium. Number 5. Q. Scenario. An accountable officer dies while still holding custody of agency equipment. What must the agency head do? Designate a custodian to take charge of the property until a successor is appointed and qualified, and may appoint a committee to inventory the property and determine responsibility for any shortage. Next slide. 15 challenging questions. Number 6. Q. Spot the error. The verified inventory for GSI's property insurance is a one-time submission made when an agency first registers its properties. Correct the statement. It is an annual submission, due not later than October 31st of the ensuing year. Next slide. 15 challenging questions. Number 7. Q. Multiple choice. A request for relief from accountability for a 300,000 pesos loss due to theft is decided by the auditor, B. The cluster or regional director, C. The commission proper, D. The head of agency A, B. Amounts more than 100,000 pesos but not more than 500,000 pesos fall under the cluster or regional director's jurisdiction. Number 8. Q. True or false? A relief from accountability request may be filed at any time, with no deadline, as long as the loss is genuine. False. Both the notice of loss and the request for relief must be filed within 30 days, or such longer period as Commission on Audit may allow. Next slide. 15 challenging questions. Number 9. Q. Spot the error. Bulk storage refers to a stack requiring about 3 pallet stacks, stored to maximum height. Which stacking type does this actually describe? This describes medium lot storage, not bulk storage. Bulk storage refers to large block stacks of the same item. Next slide. 15 challenging questions. Number 10. Q. True or false? An inventory committee may consist of just the property custodian alone, since that officer knows the items best. False. The committee must have 2 or more employees, including the supply or property officer or custodian, scaled to the extent of the agency's property accountability. Number 11. Q. Multiple choice. The current PPE capitalization threshold under Commission on Audit Circular Number 2022-004 is A. 1500 pesos, B. 2500 pesos, C. 5000 pesos, D. 1000 pesos, A. C. The threshold was raised from 15,000 pesos to 50,000 pesos. Next slide. 15 challenging questions. Number 12. Q. Scenario. A repair estimate for a generator comes to 55% of its fair market value. What is the correct classification? The generator is no longer economically repairable, since the estimate exceeds the 50% of fair market value threshold. Next slide. 15 challenging questions. Number 13. Q. Spot the error. Payment for repair of government equipment may not exceed 50% of the current market price of similar equipment. Correct the figure. The cap on repair payment is 30%, not 50%, of the current market price of the same or similar equipment. Number 14. Q. True or false? Semi-expendable property classified as high-valued costs more than 5,000 pesos but less than 50,000 pesos per item. True. Low-valued items cost 5,000 pesos or less. High-valued items fall in the more than 500 pesos but less than 500 pesos range. Next slide. End of session.